Good afternoon. This is Dave Klayman from 12 Points. It's noontime on the dot. It looks like we're waiting for a few more attendees, so we're just going to give them a minute or two to join us, and then we'll get started. Thanks for hanging on the line. All right, well, it looks like we're going to get started here. So, again, thanks for joining us for the April webinar. My name's Dave Klayman. This is Buying and Selling a Home, the Process Simplified. For those of you who don't know me, I'm the co-founder, principal, and CEO of 12 Points. Founded the company 4 years ago with the idea of improving the trustworthiness of the financial services industry. In fact, just this morning, someone said to me, I'm afraid to give my money to financial people because I don't trust them. I said, yeah, well, me neither, so we'll call it even. And today I'm joined by our expert in the area, Jeff Rolk. Jeff, could you tell us a little about yourself?
Hey, Dave, thank you. My name is Jeff Rolk. I am with Gold Coast Mortgage Services. We're a small independent broker up in the North Shore, Massachusetts. We're located in Beverly, and I live up in Salem. So we provide financing for residential home purchases is our primary business.
Great. Thanks for joining us today, Jeff.
My pleasure.
So a little bit about what we'll cover today. We'll talk about affordability, the mortgage process, tools and resources that you might have available, costs, and then timing. So how much house can you afford? So I'm going to let Jeff talk a lot about this, but the first piece I'd like to add is two little anecdotes. So the first time I really ever thought about how much one should afford in a home was when I was in school, and someone said it should be between 28 and 30% of your income. So in 2008, my sister decided that she was going to buy her first home. And she came to me and she said, what do you think? And I said, I think you can't afford it because it's like 40% of your income. And she said, well, the bank wouldn't loan me the money if I couldn't afford it. And I said, have you read a newspaper lately? Have you seen the mortgage crisis going on in this country? So it happens. And then even just a few weeks ago, I had a participant from one of our 401k plans come to us, and he said, you know, I'm thinking about buying a house. Can you help me work through the process? And we were talking it through. And I said, geez, I think that's a little high. I don't know what you could get approved for. And I said, hold on, let me call Jeff. And Jeff called me back and said, we're actually seeing some lenders go to as much as 55%, and I almost literally fell off my chair. So, understanding how much house you can afford and being comfortable with that before you get to the lenders, I think is a great process, and that's where we can lean on Jeff's expertise a little here.
Yeah, thanks, Dave. So there's a few things that we just talk through with all of our clients, and what goes into what you can afford is your income, your down payment, and then your credit score. And those three things combine to create a pre-approval or a pre-qualification, depending on who you're working with. And in that process, we find out the maximum amount. So it's anywhere from 40 to 55% of your income can be used towards a mortgage. And there's a few different ways to use that. If you want to qualify on one of two people, you might max that person out to keep the other person off the loan, and that's a strategy to keep somebody's credit free of the mortgage if you ever need to purchase a second home or if you're going to move out of that house in the future. But what we really do is once we find out that maximum, we translate it into a monthly payment. And then we work backwards with, here's the most that you could pay a month. How do you feel about that? And then what would you prefer? What's a more comfortable monthly payment? And how much mortgage does that translate into? And then we can reverse calculate how much down payment you'd need to use to acquire that large of a mortgage to make the home purchase. So that helps you really correctly build in your head what to go out and shop for, because $300,000 and $400,000 are both a lot of money, but what does that translate into a monthly payment? That's much more meaningful to the client.
And then understanding credit scores. So one of the things that people don't know, it's this, oh, I have some kind of a credit score. I don't know what I have. So, they can range between 300 and 850.
Yep.
And, what's a good credit score? What's a bad credit score?
Yeah, so in mortgage lending, it's typically a 620 is the minimum credit score required. And then in brackets of 20 points, so from 620 to 639 is a bracket, then you're in 640. And it goes all the way up to a 740. 740 and above is considered the top tier for lending. If you're trying to achieve a larger mortgage, a jumbo loan, generally a 700 is the minimum credit score to get into the jumbo category, because you're asking the lender to assume more risk money-wise. They're going to require a higher FICO score. And credit it's an interesting beast, but that's why we always recommend that people go see a professional, have your actual FICO scores pulled by a mortgage company significantly in advance. And that way any issues that could be ironed out somewhat easily can be done, because your credit score can be worth $100,000 over the life of a loan. If you had a 60 or an 80 point swing, and sometimes it's a quick fix that in a month or two can really raise your score, and that'll save you significantly in the long run.
And those are things, especially in today's environment with identity theft and all the other issues we've had, making sure that you know that your credit score is correct before you go shopping can really help you. So that's something. And again, the most important thing when calculating credit scores, I believe, still is your primary home and paying your mortgage.
It's paying your mortgage, and then it's your utilization. So if you have a lot of debt, you have a chance of filing for bankruptcy. If you don't have a lot of debt, you really can't go bankrupt because you have nothing to escape from. So you want to make sure that ideally none of your trade lines, your credit cards, are above 30% of their maximum. Once you get to above 50%, it starts to really affect your score. But if you don't, if you have a $10,000 credit card and you don't go above $3,000 and that pays your monthly bills and then you pay it right off, you're going to be exercising your credit but not overutilizing it, and that's really one of the main things that the algorithm likes to see.
And then the bottom thing we have here on the slide is estimating the annual cost of home ownership. So unfortunately, it's not just your mortgage you're paying. So it's thinking about, what are my taxes? What are my utility bills? The larger the house, the higher utility bills you're going to have. Mm-hmm. Are there certain innovative things in a home that save you money? Do they have solar? Things like that could potentially save you money in your utilities. How much insurance am I going to pay? What's the maintenance on the home? So all those things factor into your total cost of home ownership, not just your mortgage.
Absolutely. So taxes vary from city to city, and then they're paid differently depending on state. So New Hampshire pays them twice a year. Massachusetts pays them quarterly. And when you're shopping for a house, if you go to any of the listing sheets, it will have the annual taxes listed on it for that year. And you divide that by 12 and add it to your mortgage payment. And that's how your taxes will likely be paid, through an escrow account. You can elect to pay them outside of it, but it's a free service, and the majority of clients just end up electing to keep the taxes paid through the mortgage. Your utilities are really no different than a rental utility. You have to pay for gas, or you have to pay for oil, or you have to pay for electricity. And then, your cable bill and whatever else is optional, basically. So the utilities are how efficient is the home, and this can all come up at the home inspection. And then your insurance, it's very easy to get an insurance quote ahead of time. You can send your current insurance provider the listing sheet and just say, what's the rough estimate on us insuring this home? Maintenance is an interesting one. My home inspector that I use a lot up in the North Shore area always tells clients, just plan on putting about 3% of the home's value back into the house a year. And that doesn't mean exactly 3% every year. If you paint the house, you're probably going to spend a little more than 3%, but you need to paint a house every 7 to 10 years. If you're doing landscaping, if you're paying to upgrade the basement or the utilities, you're going to spend around that 3%, and that's going to keep your house up and running and moving and marketable as well.
So in a $500,000 house, you talked about $15,000 a year to be thinking about. So
exactly.
Got a question coming in here real quickly on the tax law. So that is something to be mindful of with the tax law having changed and capping your deduction on local taxes and state and local taxes. You need to be thinking about how much different communities and how they tax and what your tax rate per thousand looks like in your home.
Yep. And different houses, some communities have a lower tax rate but a higher assessed value, and every one of those is public record, so you can find all of that out before you even make an offer on the house.
So the mortgage process and decision points. So different things to think about. What term mortgage do I want? Do I want a 15-year? Do I want a 30-year? How much down payment am I willing to make? Do I want a fixed rate loan or a variable rate loan? This is one where Jeff and I have a little debate going on. And then what the heck is a point? Points for my football team are good. Points in my mortgage, maybe not so much. So Jeff, maybe you can help us out a little bit with that.
Yeah, so the mortgage term, typically at Gold Coast, we're a relatively conservative company, so we advocate for the 30-year mortgage term. That keeps your payment the lowest, and that's your required payment. So you do have the ability to pay a mortgage off early. In the state of Massachusetts, where the bulk of our business is, there is no prepayment penalty allowed. So if somebody was interested in a 15-year mortgage, sometimes we'll lock them on a 30 and then help them make a 15-year payment, calculate that out. So if anything changed in the future for them, they would have the option to go back to the 30-year payment without refinancing, which would trigger expenses and effort and a lot of other things that might hamper what they need to accomplish with that money. Down payment, again, is a factor in the pricing of a loan. Conventional loans require 5% down. There's some government products that will go to 3% down or 3.5%. And then, as with tradition, if you go above 20% down, you don't pay any mortgage insurance. So 20% down is a great goal. If you can do 15, if you can do 10, you'll pay less mortgage insurance than you will if you do 5. So the down payment is, it's a savings goal, and sometimes a savings campaign can get people to where they need to be. But your mortgage professional will help you either say, do we have enough to execute now, or should we potentially rent for another year and save like crazy?
And one thing that comes up a lot with our retirement plan clients, they ask about, should I take money out of my 401k in order to increase my down payment and thereby reduce my likelihood of paying PMI? And one of the things that they talk about is everyone says, oh, in my 401k I pay myself back the interest. This is fantastic. You do, however, the money that you're taking out is pre-tax money, so you haven't yet paid taxes on it. The money you're going to pay your loan back in is post-tax dollars. And then, unfortunately, when you go to take that money out in retirement, you're going to be paying it back in post-tax dollars again. You're going to pay taxes again on that money. So you're going to get taxed twice. So if you think about yourself being in a 25 or 30% tax bracket, the higher loan is probably a little cheaper than 25 or 30%. So in general, we're not fans of taking loans out of your 401k account.
Yeah, and I consider it my duty to just steer people towards their advisor on that. We don't give financial advice or tax advice, so it's easiest to just say, why don't you talk it through with the person that you trust with your money. So
there's that trust word again.
Yeah.
So fixed versus variable?
Yeah. So historically, we are a fixed rate company, particularly right now in a raising interest rate environment. Just the likelihood of a variable rate mortgage benefiting somebody is in the extreme short term. If a 7-year fixed rate period were to expire, 3 years from now, pretty much all, financial predictions are saying rates are going to be higher. So we really advocate for a fixed rate loan, and if rates go down enough that we can do a no points, no closing cost refinance, it's no cost to the client to accept that lower rate. If rates go up, it's permanently fixed. They're not going to have a clock ticking in the back of your mind, for the next 3 years while you're wondering when should I refinance now or should I wait? It's a fixed rate. It's one less thing to worry about.
And I'm going to say right now we agree. We are in a rising rate environment, and fixed makes sense to us. The time where Jeff and I originally debated this was because the average person stays in their home for 7 years. So I happen to like the 7-year arm, so 7 years of fixed rates and then adjustable after that, but not right now in this environment, but something to think about over the long run.
Absolutely. And then points. Points are an interesting beast. What a point is 1 point equals 1% of your loan. So for easy math, if you have a $100,000 mortgage, a point is $1,000. And you can either get points or you can pay points. So if the going interest rate was 4.5%, and you said, I would like 4.25, how do I get there? You'll be charged points. So you'll pay a factor of your loan up front at closing to then get a lower interest rate for the duration of your mortgage. If, let's say, you didn't have the full 5% to put down and then cover all of your closing costs, and you said, well, 4.5% is a good rate, I would accept 4.75 on the $100,000. That will give me 2 points. The lender will actually put $2,000 towards your closing costs. So you can pay points, or you can get enough of a credit to be no points, no closing costs. So covering your closing costs means no closing costs, no points mean you're not paying any additional money to get to that rate. So we try and steer people away from paying points for the same reason. If the interest rate environment was to come back around to lower than that rate, any time that you own that home, paying those points was now an expense. You'll never get that money back. So getting to a no points rate and paying your own closing costs is probably the most fiscally effective way of closing on a home. Gaining some money to cover some closing costs is an acceptable term if that's what works for the client.
And I think one of the things that we talk about when we speak with clients and prospects, there is the bookshelf behind me, and it has a bunch of books that say this is what you should do, and then there's the what can you sleep at night with. So the should, we don't like people paying points, but if that's going to help you sleep at night to have that lower mortgage rate, then you have to do what makes you feel comfortable. But understanding the decisions you're making are really what we're trying to get to here today.
And if there's a very small fee, so points come in 1/8%. So if someone had a $700,000 mortgage and it cost them 1/8 of a point to lower their interest rate by 1/8%, that's a cost of about $900, and you would lower your mortgage payment by $50 a month. So within 16 months, you go positive on that. So that's something that we'll bring to the client. Say for a very small expense compared to the mortgage, you'll turn profitable on it pretty quickly. If it costs 1.5 points to do, it's fantastically expensive, and you start running up against, will I still have the mortgage when this turns positive?
Back to my 7-year argument. So tools and trusted resources, you can do just about anything online these days. I've used mortgagecalculator.org for probably 15 years now. Yes, I'm that old. So I think it's a great resource to be able to quickly calculate mortgage numbers. Again, having a professional help walk you through what does that actually mean and can you really afford that, like Jeff, is very helpful. And Jeff actually had some other tools that I hadn't even thought of yet.
Yeah, so once we've been through the pre-approval, pre-qualification process with a client, I'll actually steer them towards some of these calculators. So there's some apps you can download. One's called Financial Calculator, and it just has like 10 calculators built into it, and one of them is a loan calculator. So once you know your functional qualified area, like if you know that you're qualified for up to a $450,000 purchase, but you're going to go look at a house that's $390,000, well, what's the mortgage payment on that? So you can use one of these calculators very simply. Clients will email me and say, like, well, what's the rough interest rate right now? And then they can plug that in, and then they say, okay, if I offer this or if I offer this, how does that change my payment? And that gets them in their comfort zone to make an offer on the house. And then right when you're ready to make an offer, I do like to be involved, so the calculators are great for planning. But a second set of eyes on it's always good, and you're not bothering a mortgage person by asking them to talk to you about mortgages. So the calculators are a really helpful tool to visualize exactly what you're getting into.
And what's the difference between a lender and a mortgage broker?
Yeah, so a lender works directly for the institution that's lending the money. So a local bank, a credit union, if they lend money, their mortgage loan originators work for the lender. My firm is an independent broker, so we collect the client's information and we shop it at any one of usually about 6 lenders, and then whoever has the best terms for our client will be able to place the business with them. And other than rate, there's a few things that go into that. The quality of the lender really does matter. If they sell the loan or not can really affect the client's day-to-day life. There's been some issues with some of the loan servicing, so whenever possible, we place our clients with a lender that won't sell the mortgage. They'll service it or use a servicing company, but they will hold the mortgage for the whole mortgage. And that just allows me to be a little more flexible.
And I can't tell you the value of that. My loan got sold last year, and the company will not stop emailing me, calling me. It is so annoying. And they think they have a great name. I won't name them here, but it's the stupidest name I've ever heard in my life. But anyway, and then a lawyer. This might sound obvious, but you should have a real estate lawyer do your closings. Well, we've seen people who are like, oh, I have my attorney. Yeah, he's not a real estate lawyer. He doesn't know he or she doesn't know what to look for. So that can be a real benefit to you in having someone who understands.
Absolutely. And the other main benefit is the real estate attorney is the main point of contact between the purchaser and the seller's side. So if a date needs to change, the attorneys are the ones that discuss it and bring that to the realtors and to the clients. So having a seasoned real estate attorney, they're just going to have kind of the bedside manner needed to keep a deal together. If you have an attorney who maybe doesn't know the nuances of real estate, they just might inadvertently, blow a deal up. And we've seen it happen. And, the attorneys that we work closely with, like, I just trust explicitly. I can send an email and say, can we ask to change this date to that? And they'll smooth it over with the other side and keep the deal moving. And same for us. When our attorney receives something, they'll bring it to us. They'll present it why the seller's side wants that, and we'll make a decision with the client on how to proceed. So it's a really good practice to have a seasoned real estate attorney.
And then, of course, property insurance. Making sure that you're properly insured, making sure that your property casualty insurance provider. Insurance is commoditized in the state of Massachusetts. It's regulated, so everybody thinks, oh yeah, well it all costs the same. Let me go to the General or whatever that stupid ad is that drives me crazy on TV. But having an advisor in your corner who can actually point out nuances is super important for you.
Yeah, and having all of your paperwork correct in Massachusetts state specific is a requirement of the lenders. So again, working with a professional who's provided a correct binder, you're just going to increase your chances of success by how many quality people you're surrounded by during the deal.
Working with a real estate agent. So know who the agent is working for If you're there and you walk into an open house and there's an agent there, they're the seller's agent.
Exactly.
And you need to understand that they're not required to act in your best interest. So you may want a buyer's agent on your side.
Yeah, so a buyer's rep or a buyer's agent is free to the buyer. So all of the realtor's pay comes out of the sale of the home, and then it's split between the buyer's and the seller's agent. So people are a little shy, people wonder, well, what's it going to cost me? There's no additional expense to have a real estate agent. Second, just like shopping for your mortgage person, pay attention to their online reviews. If you steer clear of the real estate specific websites, a lot of those, you can pay a fee or be part of a membership to kind of up your rating. But Google reviews are, Google screens them, and Google deletes reviews that it suspects aren't genuine. So if someone has pretty solid Google reviews, it's a pretty good sign for them. I know you can basically buy and sell a lot of the other online tools. So that's a great way to look at it. Make sure that they're the reviews, and then make sure that you like spending time with them, because you're going to spend a lot of time with them. And having them be knowledgeable in the area you're purchasing is the other key, because all realtors know each other eventually. So if a realtor from across the state approaches and a realtor from the same town approaches, and they both say, hey, my clients are good buyers, they're going to believe the person that they see every single week, and they're probably going to feel more confident in that offer. So it may cause a little bit of an upset if you have a friend that's a realtor, but consider using somebody who lives and works in the area where you're going to purchase.
And the same thing if you're on the sell side. Make sure that you've got someone who understands the local market and can get you the best price and understands your market from a pricing standpoint too. Someone who sells condos, you shouldn't have them sell your $4 million house necessarily, unless they're high-end condos, but a low-end condo.
Nice condo.
So, you want to make sure that they're able to advocate for you at both price level and location. There is the old saying, all real estate is location, location, location.
Absolutely.
How much cash should I plan on coming up with before the transaction is complete? Well, if you're the seller, not a heck of a lot other than mods for your house, etc.
Exactly. So, a lot of times the seller would want to have a small fund for after home inspection. So typical things in a home inspection, they might recommend that the heating system gets serviced. Maybe that's $1,000. Or they might say that some of the shingles need to be repaired. On the house that my parents recently purchased, there was like woodpecker damage, so they replaced some clapboards on the side. So you got to pay somebody to do that, so you don't want to have no money available. But it's pretty easy on the sell side. And then on the buyer's side, you're responsible for your down payment. So that's, a percentage of the purchase price. Then you're going to have your closing costs. You have to pay for a closing. And those expenses include your attorney's fees. You have to purchase a page from the Registry of Deeds to record your new deed. The attorney will have to do a title check of the property. The attorney will have to do a plot plan. You'll have to get your homeowner's insurance and your taxes, which those are separate from closing costs. Figure closing is between $2,500 and $3,000 in addition to your down payment. And then you have to fund your escrow account. So that takes up to 6 months of the tax bill. So if you take your current year's taxes and divide it in half, count on needing potentially that much. That's the most you'll need. So if you have it available, everything else is good news. And then you're going to have to come up with 14 or 15 months of the homeowner's insurance, because that's paid annually. So you'll pay your first year before the closing, and then you'll prepay a couple of months to get some money into that escrow account. Once you close on the house, that'll be part of your monthly payment. So you'll pay 1/12 of it every month, and the mortgage company will pay your annual dues and your quarterly taxes.
And we've got a question coming in on title insurance. Thoughts on title insurance?
Yeah, title insurance is very important. It is optional, but not for the lender. So as a purchaser, you pay the lender's title insurance, which I believe is pretty telling on how important it is. And title insurance protects you from claims made by people connected to old owners of the property. So if there was a divorce in a family, if there was a death and somebody didn't get their cut that they were supposed to get, there's the potential of a lawsuit against the current owner of the property. And title insurance is a one-time fee. It's only paid at purchase. You don't pay it if you refinance. You will have to pay lender's title when you refinance. But that's the importance of that product, is to protect your asset from claims of previous owners. And I've never had a client not take title insurance after a discussion about the importance of it.
Yeah, it's relatively inexpensive, and it solves a lot of problems.
It is. The attorney provides that, so I'm comfortable saying that I've convinced everyone to take it, and it's not a product that we sell. It's just a necessary safety instrument.
Is an attorney necessary? Well, I think we've pretty much answered that question.
Yeah, in Massachusetts it's legally necessary, and then, like we discussed, a real estate attorney should be the standard.
And you should have your own attorney. I saw someone where they wanted the bank's attorney to represent them, and that's the wrong side of the table.
Yeah, so if a lender might have an approved attorney's list, depending on who you work with, you may be able to find an attorney that's recommended to you that's on that list. My firm has an open attorney's list, so I'm happy with the fact that I can hire somebody that my client's comfortable with, or we can make a recommendation. But the quality of the team around you, so the attorney, the realtor, and the mortgage provider, are the key to success, and the attorney plays a major role in that. So,
home inspections. So one of the things I've seen in purchasing homes, and I've purchased too many of them and sold too many of them, is people who say, oh, well, if we waive the home inspection. Don't waive the home inspection.
Yes, so home inspection is the best $500 you'll ever spend. I've had several deals fail because of home inspection, and the clients have a rough day because they had their heart set on the house. But months later, when they're into their new house, and they say, wow, I'm really glad we didn't buy a house with all those problems. The home inspector is hired by the client to create a report on the house. It's not for the lender, that's the appraisal. And the home inspection is for you. So are there any $50,000 problems? Are there any $10,000 problems? Are there any $500 problems? And then which of those are acceptable? You can know that you're getting into possibly needing a new roof in the next 5 years. And you'd say, hey, can we set aside 1/5 of that every year and then just do it? Or, geez, I really don't want to purchase this house at this price and then have to put that much money into it so soon.
It's also a place for negotiation with the seller.
It is, and that goes back to the seller's fund that we talked about they should have. Is home inspection usually generates those things. So if you have a leaking pipe in a bathroom, that might affect the ceiling below. So they'll have a painter come in and do a repair and then service the pipe. They'll have, we've seen a million different things happen, but the home inspection is the root of it. In a really, really competitive environment, we've seen some people have success with bringing their own home inspector to the open house. So you do kind of a guerrilla home inspection, and this is, it's a neat strategy because then you can waive home inspection. But if someone says we're thinking about just waiving it for the sake of being aggressive, the home inspection is really your last line of defense against finding out that this house isn't as it appears.
Yeah, and one of my favorite quotes is, it's not what you don't know that'll kill you, it's what you think you know that just ain't true. And that's the point that the home inspector can make for you. When I purchased my home, it's built in 1760, and the floors sag, and I have a bowl and everything. And the inspector looked at it. I said, I'm okay with fallen. I'm not okay with falling. So I need you to determine the difference. Is my house fallen and settled here, or is it still falling? Because that's a much different situation. So, and we ended up having to, and the home inspector wasn't comfortable. We ended up bringing in a specialist for colonial homes. So, but it ended up paying off, and really found some things that needed to be done. They had actually put the wrong size sills in to support the house, so we had to make a decision about whether the house was going to be jacked up to replace those or not. So that was a major decision.
Yeah, that's all of that stuff goes into whether or not you want to own the property. And more information is always good. So home inspection is the key.
Saved us $25,000.
Yeah.
So seasonality of housing market. Obviously, the reason we're doing this webinar now is we're in what they call the spring selling season. Thank God spring finally arrived in New England last weekend. It has been missing.
Yeah, so the spring market is exactly that. It's mainly driven by the school year. So people get excited. It's easier to move in the spring. It's easier to move in the summer. It's easier to move in nice weather. But there's a date in most towns where if you're not a resident, your children don't qualify for that school system. And June 30th is the most predominant cutoff date. And because of that, June 30th is the busiest day of the year at every registry of deeds in Massachusetts. So the school year drives it. So clients who maybe are younger or maybe are downsizing, they don't have kids anymore, empty nesters, they'll notice a cooling in the market through July and August. And that's because people tend to settle down and say, okay, well, how are we going to regroup? And then there's potentially another flare up in the fall. End of the summer, people want to get into their house before summer vacation ends. So a lot of it's driven by the needs of their family.
So, an optimal time to sell there, Jeff might have told you, is early on in the season. Buyers, maybe if you've got time to wait, you can wait a little bit longer as people start to get anxious because they don't want their pictures to start showing leaves on the ground and all of a sudden there's snow around everyone else and, oh man, you haven't sold that house in a while. That's been sitting, those pictures are old.
Yeah, so, the housing market's driven by a million things for the buyers. So it's usually a change in job or the size of your family or, something that's a little bit less out of your control. People don't decide to buy in the fall or in the winter, they need to. But it's a 24-hour market and it's every day of the year. So houses get bought and sold constantly. So it's really when's the right time for you to make a move, and then the housing market will be what it is when that happens, and it will be what it is when you turn around to go and sell it. And you can't plan for it.
Geez, he sounds like the people who tell me I can't time the stock market either. And the other thing that comes to mind for me is I'm starting to see, even though it's spring, I'm starting to see listings where I get an email and it says price reduced from. I'm seeing more of those lately than I've seen over the last couple of years.
Yeah. So there's an inflation in the housing market, and at some point there'll be a correction. And, the market, just like every other market, is in a cycle. So we're at a high point. It's great to be selling. It's, buyers are buying. So it's an aggressive time for people. The overall market is doing really well. So people have money and people want to buy. Real estate isn't a short-term investment. So if you buy and in 3 years have to sell, there's the potential that you would sell underwater or have to take a loss on it. If you buy and hold for 7 or 10 years, it's fairly unlikely that you'll not see some upside on that, no matter when in the cycle you buy, because you'll be through to the next cycle. So, you just got to stick with the plan and
ride them out, as they say.
Exactly.
So we appreciate your time. I know we ran about 6 minutes over our half hour, but wanted to make sure we got all that information in. There's our contact info there. You can reach me at dave@12pointswealth.com or 978-318-9500. And Jeff, your contact information is there as well.
Yeah, feel free to email me any questions or just give the office a call, and happy to follow up if anybody has a side discussion that they'd like to talk about, or I can add value in any way. And
I can tell you, Jeff is one of the most responsive individuals I've ever met in my entire life. So he's a great partner to us here at 12 Points, and I can't thank him enough for being here with us today.
Thanks a lot, Dave.
Thank you, everyone. Have a great day.